Hey, everybody, welcome back to another episode of Milkshakes Markets Madness. In this episode, Brent gives us some of that deep dive, global macro stuff that we love so much.
And we're also going to talk a little bit about how to avoid the slaughterhouse. The herd is running and the herd is very confident right now. And there's nothing wrong with being with the herd, but you just got to be on the lookout for the wolves on the sidelines.
So join us so that you can be both protected and prepared for 2024.
Randolph and Mortimer Duke.
My God, we're ruined.
All right, everybody, welcome back. Milkshakes Markets Madness, Season 2, Episode 2. My name is John Kutsmeda. This is Brent Johnson. We always like to remind people, especially new to the show, that we have a playlist on top of the YouTube channel that's called Start Here. And so if you're not familiar with Brent's dollar milkshake theory, or if you are familiar, you probably have it wrong because Brent is frequently misunderstood about what it's actually trying to say. We do encourage you to watch that video. And perhaps one of the reasons I mention it, even though I typically do at the beginning of every show, is Brent, it seems like you have a bit of, should I say, empathy for central bankers lately, because certainly it seems like they've been misunderstood.
Yeah, I think the market continues to misunderstand what they're saying. Now, time will tell who has it right and who has it wrong. But, late last year and even into the first week of this year, the market was pricing in 7 rate cuts. And while the Fed, in my opinion, definitely signaled, somewhat of a pivot and, indicated that probably the next move would be a cut. They were now talking about the cut. Nowhere along the way did Powell say he was shifting hard, going to give 7 rate cuts, and you guys better get into risk assets because, easy times are coming again. And but that's what the market heard, right? And so we kind of had, and it was kind of interesting because into the end of the year, that was definitely the case. The market heard rate cuts are coming, get long because the liquidity is coming back. What's kind of been interesting to me so far this year is that as data would come out, it didn't really push things higher, and the markets kind of felt very uncertain. And then this week, equities were down, not hard, but fairly hard the first 2 days, I think into either Tuesday or Monday was closed down. They were down Tuesday and then down Wednesday morning. But by Wednesday afternoon, they'd kind of started to rally, and then they rallied pretty hard Thursday, Friday. So we kind of finished back pretty close to all-time highs. I think maybe markets are up 1-2% for the year now or something, whereas they were down 1 or 2% in the first week. But we also started to see, which was interesting to me, is that we also started to see the rate hike expectations start to come down. So whereas at the end of last year, beginning of this year, there was like 7 rate hikes priced in, now there's 5 or 6 rate hikes priced in. So they've kind of priced out one of the cuts, but yet markets are still believing that this big flood of liquidity is coming, and rallied pretty strong into the end of the week. So I continue to think that the market is misunderstanding what the Fed is saying, and here's part of it. I think it's partially understandable because I oftentimes have said over the last couple of years that Powell is the most plain spoken and easy to understand central banker that I can remember. And central bankers are famous for double speak and words that don't make necessarily sense and kind of talking out of both sides of their mouth. And I always thought Powell was kind of unique in that he didn't really do that. He spoke very clearly. But when he in December, at the beginning of December, he was very clear that rate cuts weren't coming yet. And then literally 2 weeks later, he's like, well, now we're talking about rate cuts. So something clearly happened, and I'm still not quite sure what it is. I don't think anybody is. And so perhaps, it's by his own accord that the market is misunderstanding what, because he's starting to speak a little bit more confusing than he initially did. And so to me, I just think that this is a very, very dangerous environment. Doesn't mean there's going to be a crash, doesn't mean there's going to be a crisis, but when you have everything as stretched as it is, and you have positioning as it is, and then you have words from central bankers and monetary authorities in an environment where I think they're being misunderstood, to me, that sets up not necessarily trouble, but the possibility for trouble.
Well, we usually, I feel like, have a tail wagging the dog situation where markets and market behavior kind of forces the Fed into certain policy decisions. And I think all throughout this rate hiking cycle, which really started late first quarter in 2022, didn't really pick up steam until July of that year when we had a 9% CPI print. They've been aggressive throughout that summer and then naturally kind of taper things off as it seemed like those hot prints were in the past. They didn't necessarily solve the inflation problem. And it's important to understand that inflation is measured year over year. So it's not like we're in a disinflationary environment. So all those price increases are still impacting the economy. But the Fed made what felt like appropriate adjustments to kind of slow down the pace of things. And it continually felt like the market wanted to be the tail wagging the dog, forcing the Fed into something like a pivot or into some sort of rate cuts. And all last year, the market was front running them eventually having success in shifting Fed policy. Now, being as high as the overnight lending rate has been, it's in the 5% range. No one thought they would ever get here without blowing up the world, let alone the U.S. economy. So here they are, and you look at the reality of year-over-year inflation coming down slightly. Real interest rates, interest rates adjusted for inflation, are now positive, and that usually doesn't necessarily lead to good things, especially when the spread is as large as it is. So the Fed making a rate cut or two to kind of balance that out, try to create this soft landing Goldilocks scenario makes sense. But it almost feels like the market thinks that they finally won at this tail wagging the dog situation and is forcing the Fed into massive cuts because something's desperately wrong. And maybe the Fed is just pulling off the gas a little bit.
Yeah, and that's what I think it is. And this, I think often, again, I don't want to say only in retail because that's not the case. But one of the things I've observed is people get cause and effect messed up when it comes to market action and monetary policy from the central banks or monetary authorities. I'll give you an example, and then we'll bring it back to what's actually going on. Like, I will often talk to people, especially when the dollar comes up. Oh, the dollar's going to go down because the Fed's going to have to print. Money printer go burr. And the thing is that if you think that QE is coming back, then you must also think that the dollar is going to get stronger. Because the Fed is a reactionary agency. The Fed is there to react to market conditions and keep, unemployment low and price stability. That's their official, goal. Their real goal is to keep the current monetary system running and governments in power, right? I mean, that's essentially why they're there. They're there to keep the system running. But the point is that for QE to come back, for them to have to go back to QE, it would be because dollars are disappearing, either via flowing out into the euro-dollar market or defaults. Money's disappearing, and they are now having to reliquefy the system. They're having to put new money into the system. But if money is disappearing, either via defaults or into the euro, whatever it is, then prices are probably coming down. If there's not money out there available, then prices are coming down. And whether that takes the form of, stock prices coming down or commodity prices coming down or real estate prices coming down, that's what the Fed reacts to and then does rate cuts or stops QT or goes to new QE. And so the monetary policy is not the cause. And then the dollar going up or down is not the effect. The dollar is the cause, and the resulting monetary policy is the Fed reacting, and that is the effect. And that I think this year, and maybe in a little bit last year, this kind of goes to your point, is it kind of got flipped around a little bit, right? In other words, for me, for there to be 7 cuts, the Fed has to be reacting to something. In other words, the Fed is not going to cut 7 times just for the hell of it. The only way they're going to do 7 cuts is if the market is slowing down dramatically. They not only see inflation coming down dramatically, but even the possibility of deflation, and they will be reacting with 7 cuts to that market that is the cause. And so I think I think the market is kind of trying to figure this out right now, or at least that this is my interpretation of it. Is last year the market was very sure. This year the market's a little bit more unsure, but they're still leaning towards, these cuts are coming and being long. And I continue to, first of all, admit that I could be wrong, and maybe this thing keeps rolling. But I'm also of the belief that the market is largely interpreting the central banks wrong. And I think typically that ends badly. Not always, but that typically ends badly.
Well, one of the things you were frustrated about in your own investment strategies last year was that you weren't necessarily a pessimist about the Fed and their monetary policy, but your perhaps bearish stance was more rooted in the fact that markets were overzealous. And so the Fed wasn't necessarily going to get something so wrong last year that there would be this huge crash and you were playing defense on that. It was more so equities and equity prices, primarily driven by this magnificent seven of tech stocks, was really driving everything. And you just felt like they were so over their skis that you frequently said this isn't a Armageddon correction that you're looking for, and that you would probably buy the dip, but this was, a little overdone.
Yeah, and I still kind of feel that way. Like, I'm the first to say, listen, guys, just because things are extended doesn't mean they can't get more extended. I've been in this business long enough to know that I don't know. The longer I'm in this, the more I realize I don't know, and that neither does anybody else. So what I typically do, when I have strong views, I am not afraid to, press the bet and put on, a little extra turbo behind whatever I believe is going to happen. But when I'm uncertain, then I'm careful. And when I'm uncertain and positioning and sentiment is extreme, I'm very careful. And so I think a lot of times when so I'm at a conference in Vancouver today. That's why I'm in this hotel room, and I'm going to be speaking over the next couple of days. And I think a lot of times people tune into these podcasts or these shows, and they go to conferences because they want to see their most recent guru give them the silver bullet answer that they're going to make a bunch of money and nobody else is. And what I would say is that the older I get, the less I believe in gurus. I probably believed in them myself when I first started. And the bottom line is nobody knows. And anybody who tells you that they do for sure, you should probably run the other way. But one of the things I'm going to talk about over the next couple of days is that in 25 years of doing it, think about, so I've been doing this for 25 years now. Think about what has happened in that 25 years. We had the dot-com boom and the dot-com bust. We had the resulting real estate boom, and then we had the real estate bust and the resulting global financial crisis. We had a euro sovereign debt crisis. We had negative interest rates around the world. We had 10 years of ZERP. We had Volmageddon. We had COVID, and then we had the resulting monetary policy from that. Not to mention all the skirmishes and wars and battles along the way. And all of that, I have never been more uncertain in 25 years of doing this with all of that history than I am right now. I don't know what's going to happen, and when I am uncertain, then I don't press the bet. And when I am uncertain, but I feel like everybody else is certain, when you look at sentiment and you look at positioning, there are a lot of people that they are certain of what's going to play out, or at least they are positioned for certainty. And when I look at that, when I know how long I've been doing this, how much I've studied the markets and the system and how it all works, and then I look at position and I'm thinking, I'm not certain what's going to happen, and all these people are. That to me is an environment where people can get slaughtered. Now, will they get slaughtered? I don't know. Maybe they won't. I just know that that's not an environment to be brave. I was thinking the other day, the difference between, people that fail and there are so many dead heroes, I guess is what I want to say, right? The hero is the guy that goes out into some very crazy, dangerous environment and somehow succeeds. And we glorify those people, right? And for good reason. They beat the odds. But how many people did the exact same analysis, did the exact same thing, and ended up slaughtered on the battlefield? And we don't talk about them that much, even though it's just, again, I've used this metaphor before. It's like, in the 70s, Evel Knievel tried to jump the fountain at Caesar's palace, and he crashed and broke every bone in his body. And then 30 years later, his son did the exact same jump and landed it and was fine. They both did the exact same thing. They both took the exact same risk. One of them ended up in the hospital with every bone broken, and the other guy rode away and probably went and partied that night, right? And so my point is, I don't want to be jumping the fountains at the Caesars right now. Like, to me, this is not the environment to jump. But if somebody's willing to take that risk and it pays off for them, I will absolutely give them a round of applause and say congratulations. But in my opinion, this is not the environment to try and be a hero. Because, or if you are certain and you are putting on a trade because you think this is your chance to be a hero, I respect it. But just understand the risks that you're taking, because this is not a low risk environment to do it. And I feel like in this environment, there will be the thing that I have the most conviction on is that at some point this year, there is going to be a fantastic opportunity to make a lot of money. Now, and I want to have dry powder and be in a good position when that opportunity shows up. I don't think right now that I do not see that opportunity right now in anything, but I am confident at some point this year that opportunity will present itself. So I would rather be careful now, and when everybody else is dying, then I'm going to make my move. That's my plan. Now, will that come to fruition? I don't know, but that's the way I'm kind of surveying the market right now.
Well, when you talk about the hero's journey and people loving the underdog fight, I don't know why, but one of the first things that came to my mind was the movie 300. And certainly if we had more energy and time, I could see us creating an entire 300 montage meme with different people's faces for the different characters. But look, that whole timeline that you just shared, going back to all these different crises, the .com, et cetera, throughout all of that, one of the things that, when you look at 20, 30 years ago to today, even probably further back than that, I think going all the way back to the 70s, there's always this cry throughout that entire period that the dollar is going to die. And some of those screaming the loudest are the gold bugs. And now you have, the crypto Bitcoin community behind that one. At the same time, housing, it's one of those things. It's that recency bias. The GFC was an excruciating experience, and everyone's just sitting there waiting for a 2.0. And meanwhile, housing supply is tight, home prices keep going up. And so people, they get married to these ideologies and these biases, and they get slaughtered because of that when you have all these other things that show in history that, like you're saying, trying to play hero or betting on a belief oftentimes can get you crushed.
Yeah. Yeah. And again, I want to make something clear. This is not me, telling the bulls that they need to get to the sidelines. This is not me telling people that their thesis is wrong. I'm just saying that I am not certain of anything right now. I see so much reason for uncertainty, but yet I see so many are positioned for certainty that, to me, there's an arbitrage opportunity there. Because I don't think the herd is going to be right. And the herd is very much in unison right now. And so like I said, I would prefer to kind of, sit on the sideline and watch, and not sit on the sideline. Like, listen, we're in the market, and if the market runs higher, then we're going to make money. But, again, I am always on the lookout for the kind of the rogue wave, the thing that comes out of nowhere that nobody's thinking about. And, we're in everything is right where it was 2 years ago. I mean, stocks are where they were. Gold's about where it was. Oil's a little bit lower, but, within 10%. And I don't know, man. I got to tell you, like, I just don't know. And I'm not afraid to say I don't know, because to me, I could make a case for equities to run higher into the summer, and I could make a case for them to fall hard into the first, or the second Fed meeting. And, I think I said this last week, and if I didn't, I'm going to say it again now, is I think if people are trying to figure out how to manage the markets, how to manage their own portfolios, what they should do, rather than jumping from guru to guru who happens to have been right, with their calls over the last 3 months. Instead of trying to figure out how to be right, just try to figure out how to be prepared. Instead of trying to figure out how to be right about everything, just try to figure out how to be prepared for anything. And I think if you're prepared for anything, you're going to be, you're not only is your portfolio going to be positioned better and less risky, but you're not going to be as stressed. So you're going to be thinking clearer. And then when that opportunity does present itself, you are going to be able to take advantage of it better than if you're offsides and you're stressed.
Well, like some of the comparisons you're making, the Evel Knievel really helps visualize, at one time a certain risk might pay off, at another time it might not. The term being slaughtered, I think is a good one here, as you referenced the herd, and that's a favorite thing for everyone to say, is the herd always gets slaughtered, and things have really gone on perhaps longer than they should have. One thing you did mention last week, tongue in cheek, was for you the Magnificent Seven was the idea that the Fed was actually going to cut 7 times. You kind of thought that was a joke. Here we are already stepping back from that, 7 rate cut cliff. But the actual Magnificent Seven are still performing, although some of it trading places. Microsoft, I believe, surpassed Apple in terms of market cap. At the same time, it looks like Google's doing some layoffs. Do you have any sense as to, how these things could potentially perform this year? Or is it just, again, something that you want to be prepared for either direction?
Yeah. So I tend to think, and I've said this many times, and you just referenced it again a little bit ago, that I am not a person who thinks that we're going to have this magnificent crash and we're going to be in this 3 or 4 or 5 year bear market. What I think is most likely to happen this year as a result of, I think we're going to have a reset of expectations and a reset of market expectations as far as returns and market expectations of risk. I don't necessarily think that we're going to have a recession, although I think we'll probably get some kind of a recessionary shock that makes people think we're going to have a recession. And as of now, I kind of think that that's going to be a buying opportunity. Again, reserve the right to change my mind if and when it happens, but that's kind of my guess. But part of the thing with the Magnificent Seven, and part of the reason that they did so well last year, is that technology sector kind of has a built-in interest rate arb. In a very low interest rate market, then growth, people will pay up for growth, because in a low interest rate market tends to be a low growth area because interest rates are low because the central banks will take markets low in order to stimulate the growth that isn't there. So the growth that is there will typically be in smaller supply, and because everybody wants growth, there will be an attraction of capital to this small group of companies that then pushes their valuations higher in a low interest rate environment. That's part of it. I mean, there's more to it. Don't have time to go into all of it right now, but that's part of it. And so part of the reason that the Magnificent Seven did so well last year was the expectations that rate hikes were no longer on the table. And not only were rate hikes no longer going to happen, but we were actually going to have these 7 cuts. Now, so if those 7 cuts were to appear, I think people thought, well, that's going to be really easy money. So then that necessitates or it makes appropriate these soaring valuations of technology. But going back to what we said earlier, if the Fed is going to cut 7 times, then they're going to cut 7 times because of something negative, some kind of a negative shock to the market or to the growth expectations. And in that case, I don't think we're going to have a negative shock to growth expectations with technology continuing to go higher, right? So in other words, if we got some kind of a hard landing that is now unexpected, because now everybody expects a soft landing, if some catalyst comes out of there and sends the market lower in a hard fashion, I would expect technology stocks to go down with that. Now then, if we do get these Magnificent Seven cuts, that's probably why I would probably be a buyer of this dip, because the resulting effect again, the QE is not the cause. The QE is the effect. The falling asset prices is the cause, and then the resulting effect is lower, interest rate policy or monetary policy. Then that's probably a buying opportunity on those Magnificent Seven or whatever it is, because then I think that could then provide the tailwind to send them to really, really all-time highs. And so that's where, again, I think people have the whole cause and effect thing messed up. It's why I think the Magnificent Seven did so well last year. And I think that when there is a resetting of the expectations for interest rates, then I think there will be a resetting of the valuation of technology. And as of now, I think the resetting of that valuation of technology is something that should probably be bought.
Very interesting. Well, it's a little bit of buy the rumor, sell the news. So if all last year, a portion of the performance in equities, particularly in tech and the Magnificent Seven, was somewhat of this front running a shift in Fed policy, one could argue that it's already priced in. The Bitcoin ETF is a similar example, perhaps. There was a lot of enthusiasm going into the end of the year that, an ETF was going to be approved. Suddenly, like 5 of them got approved. And, Bitcoin's down 5% or more. So, it's a perfect example that could be an analogy for what happens in tech equities if we finally do have that event. Like you're saying throughout this whole conversation, the cause and effect here is that something negative has to happen before the Fed is going to come in and juice the markets, especially since they're probably still patting themselves on the back that they've been able to get to 5.25 and higher without causing any kind of issue. And their real focus at this point is just how do we take, foot off the gas a little bit.
Yeah.
And every time they kind of hint at doing something like that, the market gets crazy and then they jawbone them back down. So they're kind of in control. It's scary to say. I think, you've said many times you don't think this is going to end well, but currently they seem to be doing things with an edge of confidence.
Yeah, and I said last fall that I thought that Powell had done a masterful job over the last 2 years. And again, not that I agree with central bank policy, and I'm a big critic of central bankers. But if you understand what their job is, and you're measuring his success based on what his job is, how could you say he did a bad job? You know what I mean? Like, if his job is to keep the system going, I mean, we know it's kind of a messed up system. We know the markets are broken. We know that governments are going to have to, continue to provide monetary support from time to time, or maybe all the time. We know that debts are going to continue to go up around the world. But the central bankers' jobs is to keep it, is that despite all these problems, to keep the system going. Well, you know what? Despite all these problems, the system is still going. So it's hard to say he has been unsuccessful in that. When, I'll use this as an example. I think there's a lot of people out there that believe that over the last, let's just call it the last 5 or 10 years, that China has outplayed the United States, or have either outplayed them or are currently outplaying them. And they believe that China will ascend, and the combination of China and Russia will ascend, and the U.S.'s best days are behind it, and it's on the descent. And I think most of these people would, if the dollar were to fall, even though it hasn't, if the dollar were to fall, let's say the dollar were to fall 10%, let's say, or even 15%, and over that same time period, the U.S. stock market went down 30% or 40%. I think those people who think that China has outplayed the United States would say, see, not only is China outplaying them, but the dollar's down 15 or 20% and the stock market's down 30, 40, 50%. That is evidence that China is outplaying the United States. However, let's look at the last 5 or 10 years. The yuan is down significantly versus the dollar, and the Chinese stock market is down significantly, and is down even more significantly versus the U.S. stock market. So my point is, how come the things that the dollar and the American fatalists say are going to happen as evidence of America's decline has currently been happening for the last 5 or 10 years to China in a big way, but yet they believe that China is succeeding and winning. So I think there's this bias when it comes to I think the U.S. in general, and I don't really, I think part of the reason is there's this moral conundrum, this woke virus that, people have come to the conclusion that the U.S. is not the bright, shining city on the hill. And because it's not this fantastic place of moral leaders that, we like to hold ourselves out to, then we necessarily have to suffer the consequences of our, impropriety around the world. And I get it. From a moral perspective, I get it. But, if it hasn't happened the last 10 years, why does it have to happen the next 10 years? And that's what I want to help people do on this channel is really kind of come up with a framework and a way of thinking of things that allows them to see through the headlines. Every time there's a headline that talks about de-dollarization, people send it to me immediately. See what I said? See, we told you. And I'm like, yes, these headlines have literally been around since 1975. Have they picked up speed in the last couple of years? They absolutely have. But the dollar is still the dominant currency in the world, despite all the arguments to the contrary. And all the bad things that everybody is predicting are going to happen to the United States are currently happening to many countries around the world, especially China. And so, I think when you're managing your portfolio and you're allocating your livelihood, your nest egg, you got to be as brutally honest as you possibly can. And I know that's something that I've said on many episodes, and there's probably some people out there who have said, Brent, you've told us that 100 times, but to the extent that there's new people that are tuning into the show and haven't heard it before, that's probably something that I'm going to harp on every time that I get the opportunity to do so, because I think it's maybe the most important thing.
Oh, I think it's good sound advice. One of the things that we appreciate in regards to the feedback we get on the show is that we tend to stay in a more grounded lane where everyone else is screaming from a mountaintop with conviction about, whatever they believe in at that moment. And speaking of, the dollar fatalist or, whether it's gold bugs, a lot of the things you're talking about, the people who are getting hyped up about various headlines, it tends to be the same ones over and over and over that are taking a headline or clip to rah-rah their crowd. But, one of the things that's interesting about that, particularly I think since the GFC, because I think that really ushered in a whole new zeitgeist, if you will, around this, like central banks are corrupt and broken. And Satoshi wrote the Bitcoin white paper and then, the financial or monetary response to COVID was just another, kind of nail in that coffin. But all of those people who can pound that table consistently, that this is the end, probably need to hear the thing that you keep repeating, which is that if there's anything you do right now, it's not about trying to find the next guru or trying to find an article that reinforces that guru's argument that has been wrong for a period of time. The thing you need to do is be prepared. And one thing I'll say on top of that is these people who are pounding the table behind their ideologies have not been prepared. They haven't been preparing themselves for the likelihood that they could be wrong. They have been wrong, and that's hurt both them and their followers. So I think it's a great idea that a big part of what we do here going forward in season 2 is to continue to remind people of that.
Yeah, and I think for anybody out there, this is the first time they're hearing this, and then they're saying, well, that doesn't sound right. Well, just do this. Go to whatever charting system you use, whether it's Yahoo or Google or Bloomberg or whatever, and just pull up a chart of the S&P 500 versus the emerging market ETF, EEM, and just look at the last 10 years, right? And see, and then do the same thing with S&P 500 and China equities, and just see how those have performed, or compared to each other for the last 10 years. I mean, it doesn't mean that this is it can't change. Of course it can change. But the point is despite all of these problems, significant problems with the United States, it is still dramatically outperforming the rest of the world. And, for the last, I don't know about this year, but like in 2023 and in 2022 and in 2021, like at the beginning of the year, the big trade, like that all the different firms were like putting out was short the dollar and buy EM. And despite that, in be overweight emerging markets. And despite that, the dollar has held up versus the other currencies, and the U.S. equities dramatically outperform, emerging market currencies or emerging market equities. And that's already happened again this year. Like this year, just in the first 3 weeks, I think the S&P 500 is up 1.5%, maybe 2%. And EM equities, the EM ETF is down like 4 or 5%. I mean, it just continues. And so, I'm kind of reminded of that line, who are you going to believe, me or your lying eyes? Well, the evidence is right there. All you have to do is look at it. And, maybe you say it's manipulated. It wouldn't have happened without central bankers. Wouldn't have happened without the U.S. doing that. Well, you know what? You need to factor that manipulation or whatever into your analysis, because that ain't going away.
Well, the other thing too to keep in mind when you're doing those comparisons is that, we can talk about the dollar versus assets, but when you're playing the relative game of currencies versus currencies, one of the things, the important part of a currency is whether or not it's being trusted and or used. And the percentage of the dollar's usage in global trade, particularly over the last decade, has actually increased dramatically. And if you're going to do a comparison of emerging market equities or Chinese equities and compare it to the S&P 500 or other major indexes, one of the things you should also do when comparing those charts is look at it in dollar terms and then also look at it in yen terms. And you're going to see the performance or the outperformance by the US equity markets is even more extreme.
Yeah, and the other thing I would say with I'm going to touch on this because I saw a tweet the other day where somebody had talked about how Russia had totally de-dollarized. They ditched the dollar fully. Several years ago they started to ditch the dollar several years ago, and then they fully ditched it. In 2021 or 20, whenever it was. And the thing is like this isn't me. This is Putin said this himself on a couple different occasions. He said we didn't leave the dollar left us. He said we would use it if they would let us, but we can't use it because we can't make payments on it. So this idea that Russia de-dollarized, no, they didn't. They were de-dollarized by the United States. Okay, I mean there is a difference. If your girlfriend breaks up with you, you didn't come out on top in that situation, right? Like if she broke up with you, she broke up with you. You don't get to say, yeah, I broke up with her. I mean, you can, but you'll be a liar. And so again, that's the reality. That's Putin himself saying it. That's not me telling you that. That's Putin himself saying it. And so again, I actually don't think that was a good idea for the U.S. to de-dollarize Russia. I think ultimately they will probably come back to hurt them, but so far it hasn't. And, there's no indication that it's going to hurt them next year either. And again, maybe it will, but the evidence is not there to say that all this de-dollarization by Russia and China is hurting the United States more than it's hurting them.
Yeah, and one of the things that you have been in agreement with, like you just mentioned, is that was probably not the best foreign policy by the U.S., but generally speaking, the bullying that the U.S. does, whether it's geopolitical or even in terms of monetary policy, and when it weaponizes the dollar, you're not necessarily in agreement with. But again, it's when those decisions or mistakes are made, it doesn't mean that tomorrow the entire world is going to de-dollarize. So again, It's a bit of taking a step back from the cliff, maintaining some composure, staying grounded, and also being prepared where if that's your base case, there's nothing wrong with that. But what happens if you're wrong? Have you thought about how to position yourself or to adjust if it turns out that you're wrong? Well, look, Brent, it's a good conversation. We're just, getting back into the swing of things. As I mentioned, this is episode 2 for season 2. We appreciate everybody joining us. Brent, we appreciate you joining us while you're at the conference. You'll have to give us some updates on how the don't follow your guru advice, try not to get slaughtered recommendation goes over the next 48 hours. And we'll see how things go at that point. So for everyone else out there, we appreciate you joining us, and we look forward to having you next week for another episode of Milkshakes Markets Madness.
Peace.
This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.